There was a moment, sitting at a kitchen table, somewhere in the middle of an ordinary Tuesday evening, when a person who had been investing for 3 years looked at a brokerage statement and felt something cold move through their chest. The numbers on the screen were not what they expected. The stock they had bought, the one they had researched, the one they had felt so confident about, had dropped 40% in 8 months. And the worst part, the part that kept them awake that night, was not the loss itself. The worst part was that they did not understand why. They had read the headlines. They had watched the videos. They had listened to podcasts where enthusiastic voices promised that this company was going to change everything. But when they went back and looked at the actual financial reports, the documents the company itself had filed with regulators, they realized something deeply uncomfortable. They could not read them. Not really. Not in the way that mattered. They could see the numbers. They could recognize the words. But the meaning, the story those numbers were trying to tell, was invisible to them. And so they had made a decision, with real money, based on hope and confidence and someone else's conviction, without ever truly understanding what they owned. If this story feels familiar to you, then this book was written for you. Not for the professional fund manager, not for the finance graduate, not for the person who already knows what return on invested capital means and why free cash flow matters more than reported earnings. This book was written for the person who is serious about investing, who is willing to do real work, but who has never had someone sit down with them, quietly and patiently, and explain which numbers actually matter and why. Because here is the truth that the financial industry rarely tells you clearly. You do not need to understand every number in a financial statement to make excellent investment decisions. The statements themselves are long and complicated and filled with details that matter mostly to accountants and lawyers and auditors. But buried inside all of that complexity, there are 10 numbers, 10 ratios and metrics and relationships that tell you almost everything you need to know about whether a company is truly excellent or merely pretending to be. 10 numbers. That is the promise of this book. Not a shortcut, not a magic formula, not a system that will make you rich without thinking, but a framework. A clean, honest, proven framework that will let you look at any publicly traded company in the world and understand its financial character within a single afternoon. The 10 numbers work together. They are not independent facts sitting side by side. They are a conversation. Revenue growth tells you if people want what the company is selling. Gross margin tells you how much value the company captures when they sell it. Operating margin tells you how efficiently the company is running. Free cash flow margin tells you if the profits are real. Return on invested capital tells you if the business is actually creating wealth. Debt to cash flow tells you how much danger is hiding in the balance sheet. Share dilution tells you if management is quietly taking from shareholders. Earnings quality tells you if the accounting is honest. Valuation multiples tell you what you are paying for all of it. And owner earnings bring everything together into a single, human-scale number that tells you what the business is actually worth to the person who owns it. Each of these numbers has its own chapter in this book. Each chapter will explain what the number is, why it matters, how to find it, how to calculate it, and how to interpret it in different kinds of companies and industries. By the time you finish the final chapter, you will have a complete system for analyzing any stock, anywhere in the world. But before you turn the page, there is one more thing worth saying. The greatest investors in history, the ones who built extraordinary wealth over decades, were not mathematical geniuses. Warren Buffett has said many times that he does not need advanced mathematics to invest. Charlie Munger built his framework for thinking around mental models, not equations. Peter Lynch, who ran the most successful mutual fund in history during his time at Fidelity, picked stocks by walking through shopping malls and noticing what his family was buying. What these people had was not superior intelligence or access to secret information. What they had was a clear framework for understanding value and the discipline to apply it consistently, even when it was uncomfortable, even when markets were panicking, even when everyone around them seemed to be getting rich off something they did not understand. That framework begins with 10 numbers, and it begins right now. Chapter 1: Revenue Growth, the heartbeat of every business. Let us start at the very beginning with the number that tells you whether a business is alive. Revenue is the total amount of money a company receives from selling its products or services before any costs or expenses are subtracted. It sits at the very top of the income statement, which is why it is sometimes called the top line. And while revenue alone does not tell you if a company is profitable or well managed or financially strong, it tells you something even more fundamental than any of those things. It tells you if the world wants what the company is selling. A business that cannot grow its revenue over time is a business in serious trouble, regardless of how clever its management is or how innovative its products once were. Revenue growth is the oxygen of a business. Without it, everything else eventually suffocates. But the number you want to examine is not revenue itself. The number you want is the growth rate. Specifically, you want to know how fast revenue is growing from one year to the next, and whether that rate of growth is accelerating, holding steady, or slowing down. Here is how to think about it. If a company had $10 million in revenue last year and $12 million this year, the growth rate is 20%. You calculate this by taking the difference between the two numbers, which is 2 million, dividing by the original number, which is 10 million, and the result is 0.2, which is 20%. In plain language, this year is 20% bigger than last year. Now, 20% revenue growth sounds impressive, and in many cases it is. But the meaning of any growth rate depends entirely on context. A 20% growth rate for a $200 billion company is an astonishing achievement. A 20% growth rate for a $10 million company might be quite ordinary. A 20% growth rate for a mature business in a declining industry might be a sign of genius management. A 20% growth rate for a young software company in a massive, untapped market might actually be a warning sign that growth is slowing. Context is everything. So when you look at revenue growth, you need to ask 3 questions. First, how fast is this company growing compared to its industry? Second, has the growth rate been consistent over multiple years, or is it lumpy and unpredictable? Third, is the growth rate getting faster, staying flat, or slowing down? Let us take these one at a time. The first question, how fast is this company growing compared to its industry, is about competitive strength. If the overall market for a product or service is growing at 10% per year, and a company in that market is growing at 5% per year, that company is losing market share. It is getting smaller relative to its competitors, even though its absolute revenue is rising. This is sometimes called shrinking while growing, and it is a red flag. On the other hand, if the market is growing at 10% and the company is growing at 25%, that company is taking market share away from its competitors. It is getting stronger even as the market itself expands. This is sometimes called a category winner, and it is exactly the kind of company that tends to produce extraordinary long-term returns for patient investors. Finding industry growth rates requires a small amount of research. You can often find them in industry reports, in the company's own investor presentations, or in the presentations of competitors in the same industry. The company will often describe the size of its total addressable market, which is the full amount of money that could theoretically be spent on its products and services, and you can use that figure to estimate how much of the market it currently occupies and how much room remains to grow. The second question, whether growth has been consistent over multiple years, tells you something important about the reliability of the business. Revenue growth that is consistent year after year suggests that the company has a durable competitive advantage, a product or service that customers keep coming back to, and a business model that does not depend on one-time events or accounting tricks. Revenue growth that is wildly inconsistent, up 40% one year and down 15 the next, up 30% the following year, and flat the year after that, suggests a business that is subject to forces outside its control. This might mean highly cyclical demand, where customers spend heavily in good economic times and cut back sharply in bad ones. It might mean heavy customer concentration, where the company depends on a small number of large customers whose own spending fluctuates. Or it might mean that the company is growing through acquisitions, buying other companies to add to its revenue, which creates its own set of complications and risks. None of these patterns are automatically disqualifying. Cyclical businesses can be excellent investments if you buy them at the right point in the cycle. Acquisitive companies can create real value if management is disciplined and skilled at integration. But you need to understand what is driving the growth pattern before you can evaluate whether it is healthy or dangerous. The third question, whether the growth rate is accelerating or decelerating, is perhaps the most important of the three for understanding where the company is headed. A company whose revenue growth rate is accelerating, growing faster this year than last year, which grew faster than the year before, is in the middle of something powerful. Maybe it found a new distribution channel. Maybe a product finally hit its stride in the market. Maybe a competitor stumbled and left room for rapid expansion. Whatever the cause, accelerating growth is a sign of momentum, and momentum in business tends to persist longer than most people expect. A company whose revenue growth rate is decelerating, growing more slowly this year than last year, which grew more slowly than the year before, needs careful examination. Deceleration does not automatically mean decline. Every growth company eventually matures, and mature companies can still be excellent investments. But decelerating growth means the easiest phase of growth may be behind the company, which affects how much you should pay for its shares. There is a concept that experienced investors call the law of large numbers, which simply means that as a company gets bigger, it becomes harder to maintain the same percentage growth rate. A company with $1 billion in revenue that grows at 30% adds $300 million in new revenue. A company with $100 billion in revenue that grows at 30% needs to add $30 billion in new revenue. Finding that kind of new revenue requires operating in markets so large that very few companies can sustain high growth rates at that scale. Amazon and Apple and Microsoft are among the rare exceptions. Now, here is something important that beginning investors often miss. Revenue growth can be manufactured. Companies can boost their reported revenue in ways that are temporary, misleading, or financially destructive. The most common method is aggressive discounting. A company can offer its products at prices far below their true value to attract customers quickly and post impressive revenue growth numbers. But if the revenue being generated is not profitable, it is not a sign of strength. It is a sign that the company is buying growth at a cost it cannot sustain. The airline industry spent decades doing this with ruinous results. Another method is channel stuffing, which is when a company ships products to retailers or distributors ahead of actual demand, forcing its partners to hold inventory they have not yet sold. The revenue shows up on the income statement immediately, but the demand was never real. Eventually, the channel gets clogged, the distributors stop ordering, and the revenue collapses. Several major scandals in corporate history involved channel stuffing. A third method is acquisition-driven growth, where a company simply buys other companies and adds their revenue to its own. This can look impressive in a growth chart, but it is a very different kind of growth from organic growth, the kind that comes from winning new customers and expanding in existing markets. Acquisitive companies often pay too much for their targets, take on debt to fund the purchases, and struggle to integrate cultures and systems, which means their growth often comes at a hidden cost that shows up years later. How do you tell the difference between healthy organic growth and manufactured growth? The most reliable signal is to look at the other 9 numbers in this book alongside revenue growth. A company growing its revenue while simultaneously improving its margins, generating strong free cash flow, and earning a high return on its invested capital, is almost certainly growing in a genuine, sustainable way. A company growing its revenue while margins compress, cash flow weakens, and return on capital falls is likely buying growth at a cost that will eventually be reckoned with. To wrap up this chapter, here is a simple framework for evaluating revenue growth. Look at 5 years of revenue data, at minimum. Calculate the growth rate for each year. Identify the trend. Is growth accelerating, stable, or decelerating? Compare that growth rate to the industry. Is the company gaining or losing market share? Ask what is driving the growth. Is it new customers, new products, new markets, or acquisitions? And look for red flags. Is the company discounting aggressively, stuffing channels, or buying revenue through deals? The answers to these questions will give you a clear picture of whether a company's revenue growth is a foundation you can build a thesis on, or a number that is telling you only part of the story. Revenue growth is the heartbeat. It tells you if the business is alive and moving. But a heartbeat alone does not tell you if the body is healthy. For that, you need to look at what happens to the money after it arrives. And that begins with gross margin. Chapter 2. Gross margin. How much does the company keep when it sells something? Picture a lemonade stand. A young person buys lemons, sugar, and cups. These are the direct costs of making and selling the lemonade. They set up the stand, they sell a cup for $1, and the lemons, sugar, and cup cost them 40 cents. The remaining 60 cents is not profit yet. There is still the cost of the table, the sign, perhaps a friend who helped make the lemonade. But the 60 cents is what economists and accountants call gross profit. And the ratio of gross profit to revenue, 60 cents divided by $1, gives you the gross margin. In this case, 60%. Gross margin is not the final word on profitability, but it is the first and perhaps the most revealing word. It tells you how much value a company captures for every dollar of its product that a customer buys before the company has spent anything on running the business itself. Technically, gross profit is calculated by taking total revenue and subtracting what accountants call the cost of goods sold, which is sometimes abbreviated as COGS. The cost of goods sold includes everything directly required to produce and deliver the product or service. For a manufacturer, that means raw materials, factory labor, and shipping. For a software company, that means server costs and the salaries of the engineers who keep the software running. For a retailer, that means the wholesale cost of the merchandise. Everything else, salaries of the marketing team, the rent on the headquarters, the salary of the chief executive, research and development spending, these are operating expenses, and they come out later. Gross margin only looks at the direct cost of what was sold. Here is why this matters so much. Gross margin is a window into the competitive position of a company. Companies with high gross margins have pricing power, which means customers are willing to pay significantly more than the direct cost of the product or service. This usually means the company has a unique product, a strong brand, or some other advantage that competitors cannot easily replicate. Companies with low gross margins are typically selling commodities, things that customers can easily buy elsewhere for a similar price, which means competition constantly pushes prices down toward the cost of production. The range of gross margins across industries is dramatic. A luxury goods company like Hermes or LVMH might have a gross margin of 65 to 75%. A software company delivering its product over the internet might have a gross margin of 70 to 85%, because once the software is written, delivering it to another customer costs almost nothing. A pharmaceutical company with a patented drug might have a gross margin of 80% or higher, because the pill costs pennies to manufacture, but the research that produced it was worth billions. At the other end of the spectrum, a grocery retailer might have a gross margin of 25%. An airline typically operates at 20 to 30%. An automobile manufacturer might have a gross margin of 15 to 20%. These are not bad businesses necessarily, but they are businesses where competition is intense, customers are price sensitive, and every percentage point of margin matters enormously. What this means for investors is that gross margin defines the playing field on which a business competes. A company with an 80% gross margin has enormous flexibility. Even if its operating expenses are large, even if it is investing heavily in growth, it has so much financial cushion between what it earns and what it costs to deliver that cushion that it can afford to be ambitious, to make mistakes, to experiment, and to recover. A company with a 15% gross margin is walking a tightrope. A small increase in raw material costs, a small decline in selling prices due to competition, a single operational disruption can wipe out a significant portion of its financial buffer. These companies must be extremely disciplined and efficient to survive, let alone thrive. Now, within any given industry, what you are looking for is where a company's gross margin stands relative to its competitors. A software company with a gross margin of 60% when its peers are at 75% is either selling a lower quality product, facing more competition, or carrying higher direct costs for some reason worth investigating. An automobile manufacturer with a gross margin of 25% when its competitors are at 15% has likely found a way to differentiate its products through design, technology, or brand that allows it to charge more for the same fundamental transportation. The comparison is the insight. There is a second thing to watch with gross margin, and it is the trend over time. Is the gross margin expanding, holding steady, or contracting? Each of these patterns tells a different story. Expanding gross margin is one of the most powerful signals in all of financial analysis. When a company is able to grow its gross margin over time, it usually means one of several very good things is happening. It might mean the company is gaining pricing power, which happens when a brand becomes stronger, when a product becomes more essential, or when the competitive landscape shifts in the company's favor. It might mean the company is experiencing economies of scale, where the cost of producing each unit falls as production volume increases because fixed costs are spread across more units. Or it might mean the company is shifting its product mix toward higher margin products and services. All of these are excellent signs. A company that can consistently expand its gross margin over a period of 5 to 10 years is a company that is compounding its competitive advantage. The business is literally becoming more valuable with each passing year, independent of how fast revenue is growing. Contracting gross margin is a warning sign that requires careful investigation. When gross margin falls, it usually means one of several worrying things. Competition may be intensifying, forcing the company to lower prices to retain customers. Input costs may be rising faster than the company can pass them on to customers, which happens in inflationary environments when raw materials, energy, or labor become more expensive. The company may be expanding into lower margin products or geographies to chase growth, sacrificing profitability for scale. Temporary contractions in gross margin are sometimes acceptable. A company might deliberately sacrifice near-term margin to build market share, understanding that once the market share is won, margins will recover and expand. But if gross margin is contracting year after year with no clear explanation and no recovery in sight, that is a company that is losing its competitive position, and the financial consequences will compound over time. There is a third thing to consider, which is the relationship between gross margin and the type of business. High gross margin businesses tend to have certain characteristics. They often have strong brands. They often sell products or services that are difficult to replicate or substitute. They often benefit from network effects, where the product becomes more valuable to each customer as more customers use it, as is the case with social media platforms, payment networks, and marketplace businesses. They often have significant intellectual property, whether in the form of patents, proprietary formulas, or trade secrets. These are the characteristics of what Warren Buffett calls businesses with moats. The moat is the competitive advantage that prevents competitors from eroding the company's market share and pricing power. Gross margin is one of the clearest quantitative measures of whether a moat exists and how wide it is. Low gross margin businesses are not necessarily bad investments. Many great investors have made fortunes in low-margin industries by finding companies that were more efficient than their peers, or that were gaining scale in ways that would eventually create margin expansion, or that were priced so cheaply in the market that even modest margin improvements would produce enormous returns. But they require a different kind of analysis, one that focuses more intensely on operating efficiency, asset utilization, and cycle positioning. One practical note before we move on. When you look at gross margin for a software company, you may encounter two different figures. One is the GAAP gross margin, which follows standard accounting rules. The other is the non-GAAP gross margin, which the company calculates by excluding certain costs, typically stock-based compensation and amortization of acquired intangibles. Companies often highlight the non-GAAP number because it looks better. You should look at both, but weight the GAAP number more heavily because it reflects the full economic cost of operating the business. To summarize, gross margin is the first filter for understanding the quality of a business. A high gross margin, in absolute terms and relative to competitors, suggests a business with pricing power and competitive advantages. An expanding gross margin over time suggests a business that is getting more valuable. A contracting gross margin requires investigation and may signal increasing competitive pressure or rising costs that management cannot control. And the trend in gross margin, more than any single year's figure, is what tells you the real story about a company's financial health. Revenue growth tells you how fast the business is expanding. Gross margin tells you how much value it keeps from each dollar of that expansion. The next question is what happens to that value as it flows through the rest of the business. And for that, we turn to operating margin. Chapter 3. Operating margin, the true cost of running the business. There is a useful way to think about the journey money takes through a business. Revenue is what arrives. Gross profit is what remains after paying for the direct costs of production. But before any of that money reaches the owners of the business, it must pass through a gauntlet of additional expenses. The sales team needs salaries and commissions. The marketing department needs budgets to advertise the product. The engineering team needs resources to improve it. The legal team needs to handle contracts and compliance. The executives need to be paid. The offices need to be rented. The computers need to be bought and maintained. All of these costs together are called operating expenses, and when you subtract them from gross profit, what remains is operating income, sometimes called operating profit, or EBIT, which stands for earnings before interest and taxes. And when you divide operating income by total revenue, you get the operating margin. Operating margin is the percentage of every revenue dollar that remains after paying both the direct costs of production and all the costs of running the business. It is a much more complete picture of profitability than gross margin, because it reflects not just how efficiently the company produces its products, but how efficiently it runs itself as an organization. Here is a simple example. A company earns $100 million in revenue. Its cost of goods sold is $40 million, leaving a gross profit of $60 million, which is a 60% gross margin. But running the business requires additional spending. The sales team costs $15 million. Marketing costs $10 million. Research and development costs $12 million. General and administrative expenses cost $8 million. Total operating expenses are $45 million. Subtract that from the $60 million gross profit, and you are left with $15 million of operating income. Divide 15 million by 100 million, and you get an operating margin of 15%. What does that 15% mean? It means that for every dollar of revenue the company generates, 15 cents flows through as operating income after all the costs of running the business have been paid. Whether that is good or bad depends entirely on the industry. In the software industry, where gross margins are extraordinarily high and the business scales without proportional increases in costs, leading companies often achieve operating margins of 25 to 40%. A software company with a 15% operating margin is either investing heavily in growth, which can be appropriate for a young company trying to expand, or it is struggling with cost discipline, which is a warning sign. In retail, where gross margins are thin and operating costs are high, a 15% operating margin would be extraordinary. Most retailers operate at 2 to 8%. A retailer at 15% has either found a remarkable formula for low-cost operations, which is what Costco and Walmart did in different ways, or it is operating in a niche with unusually favorable economics. In manufacturing, especially in competitive industries like appliances or automotive components, operating margins of 5 to 12% are typical for good businesses. Above 12% is excellent. Below 5% is concerning. This is why the habit of comparing a company's operating margin to its peers and to its own historical trend is so important. The number alone is not enough. You need the context. Now let us talk about the two things operating margin reveals that gross margin does not. The first is operating leverage, which is one of the most powerful concepts in business analysis. Operating leverage refers to the way that a company's fixed costs behave as revenue grows. Fixed costs are costs that do not change significantly when revenue goes up or down. Rent, for example, stays roughly the same whether the company serves 10,000 customers or 100,000 customers. The same is true for the base salaries of the corporate staff, the cost of certain technology systems, and many other overhead expenses. When a company grows its revenue and its fixed costs remain roughly stable, operating margin expands. The company is spreading those fixed costs across a larger revenue base, which means each additional dollar of revenue carries fewer fixed costs, which means a higher percentage of it flows to the operating income line. This is operating leverage in action. And it is why certain kinds of businesses, particularly software companies, media businesses, and marketplace platforms, can experience dramatic improvements in operating margin as they grow. The platform that costs $100 million per year to operate might serve 1 million customers comfortably, giving an operating margin of 10%. As it grows to 5 million customers and revenue grows proportionally, the platform still costs roughly $100 million to operate, but now it has 5 times the revenue to spread that cost across. The operating margin might expand to 30 or 40%. This is why investors pay so much attention to unit economics and to the trajectory of operating margin in growth stage companies. The hope is that as the company scales, the operating leverage inherent in the business model will cause margins to expand dramatically. When that happens, and it is not always certain that it will, the financial results can be spectacular. The second thing operating margin reveals is the discipline and culture of management. Operating expenses are, to a significant degree, a choice. Management chooses how much to spend on sales, how much to invest in marketing, how big to build the research and development team, how large the corporate overhead can grow. Wise management spends on things that generate returns, that create future revenue, or that protect the competitive position. Unwise management lets expenses grow without accountability, building empires of headcount and perks that do not translate into better business results. A company whose revenue is growing, but whose operating margin is declining, needs careful examination. Are expenses growing because the company is investing in future growth, or are they growing because management lacks discipline? Sometimes, growth investment is the right answer. A company expanding into a new geography, building a new product line, or hiring a sales force to pursue a large market opportunity might intentionally sacrifice near-term operating margin for long-term gains. But the investment should be traceable, explainable, and finite. If expenses are growing without clear explanation, or if management cannot articulate why margins are declining and when they expect them to recover, that is a sign of organizational dysfunction that rarely resolves itself quickly. There is a useful metric that sits alongside operating margin and helps answer this question. It is called the operating expense ratio, and it is simply the ratio of each major category of operating expense to revenue. By tracking how sales and marketing expenses as a percentage of revenue change over time, or how research and development spending as a percentage of revenue evolves, you can understand whether the company is becoming more or less efficient in each area of its operations. An efficient company typically shows declining operating expense ratios over time because as revenue grows, it does not need to grow each expense category at the same rate. The cost to acquire a new customer should fall as the brand becomes more recognizable. The cost to develop a new product should produce more revenue per dollar spent as the engineering team accumulates knowledge and tools. The cost of corporate overhead should shrink as a percentage of revenue simply because of scale. When these ratios are rising instead of falling, it is a sign worth investigating. Sometimes there is an excellent explanation, but sometimes it is a sign that the business is becoming harder to manage as it grows, and that the competitive and operational challenges are intensifying. Before moving to the next chapter, there is one more important nuance about operating margin worth understanding. Not all operating expenses are created equal. Some operating expenses are investments that create future value. Research and development is the clearest example. When a pharmaceutical company spends $2 billion to develop a new drug, that spending shows up on the income statement as an expense, which depresses operating margin. But if the drug is approved and becomes a blockbuster, the future earnings generated by that investment will be enormous. The income statement, by treating the research and development spending as a current cost rather than an asset, actually understates the value being created. This is why many experienced investors study the research and development spending of technology and pharmaceutical companies very carefully. A company that is consistently investing 10 to 15% of its revenue in research and development and generating strong returns on that investment is building a competitive advantage that the income statement alone cannot fully capture. The operating margin might look mediocre today, but the investments being made are creating the superior margins of tomorrow. The same logic applies, to a lesser extent, to sales and marketing spending. A company investing heavily in brand building and customer acquisition today might be creating a loyal customer base that will generate recurring revenue for decades. The current period operating margin understates the value of that investment. Operating margin is the most comprehensive measure of profitability that the income statement offers. It tells you how much of each revenue dollar the business retains after paying all the costs of running itself. Improving operating margin, especially when driven by operating leverage and disciplined expense management, is one of the most powerful signals that a business is compounding in value. But operating margin has one significant weakness. It is calculated using accounting rules that involve important judgments and estimates. Depreciation, amortization, accruals, and other non-cash items can influence operating income significantly without any actual cash changing hands. And in investing, cash is what ultimately matters. The next number cuts through all of that and tells you the unvarnished truth. Chapter 4. Free Cash Flow Margin, the only profit that pays the bills. There is an old saying among experienced investors, and it goes like this: revenue is vanity, profit is sanity, and cash flow is reality. You can engrave that on a wall somewhere. It is one of the most important truths in all of business finance. Reported earnings, the profit number that appears in headlines and earnings press releases, is calculated using accounting rules, and accounting rules, for all their precision and rigor, require judgment. Accountants must estimate how long an asset will last before it wears out. They must decide when to recognize revenue from a long-term contract. They must project future warranty costs and set aside reserves. They must determine how to value inventory when prices are changing. These judgments are not dishonest. They are necessary and, in most cases, reasonable. But they mean that reported earnings are partially a construction, a number that reflects real economic activity filtered through a set of assumptions and estimates. Cash flow is different. Cash is either in the bank or it is not. A company either received $20 million of actual money from customers this quarter or it did not. There is no assumption about when the revenue should be recognized. There is no estimate about how long the equipment will last. Cash in the bank is the most objective, most reliable, most irrefutable measure of whether a business is actually generating economic value. Free cash flow is the amount of cash a company generates from its operations after accounting for the capital expenditures required to maintain and grow the business. In other words, it is the cash that is genuinely free to be distributed to shareholders, used to pay down debt, invested in new opportunities, or simply held as a financial cushion. To understand free cash flow, you need to understand two components. The first is operating cash flow, which is found in the cash flow statement. It starts with net income and makes adjustments for non-cash items, the biggest of which is usually depreciation and amortization, and for changes in working capital, which is the difference between what customers owe the company and what the company owes its suppliers. The result is the actual cash generated by the operations of the business. The second component is capital expenditures, which accountants sometimes call CapEx. These are investments in physical assets, machinery, buildings, equipment, and technology infrastructure that the company needs to operate and grow. Unlike regular operating expenses, capital expenditures are not fully deducted in the year they are made. Instead, they are treated as assets on the balance sheet and depreciated over time, which is why they require a separate adjustment in the cash flow analysis. Free cash flow equals operating cash flow minus capital expenditures. And free cash flow margin is simply free cash flow divided by total revenue, expressed as a percentage. Why does free cash flow margin matter so much? For several deeply important reasons. First, free cash flow is the ultimate test of whether a business model actually works. A company can report positive net income for years while generating negative free cash flow, which means it is consuming more cash than it is producing. This happens when a company is growing rapidly and needs to invest heavily in working capital, or when its capital expenditure requirements are much higher than its depreciation expense suggests, or when its receivables are growing faster than its revenue, suggesting customers are slow to pay. A company that consistently generates strong, free cash flow is a company that is genuinely creating wealth. It does not need to return to the capital markets constantly to borrow money or issue new shares to fund its operations. It is self-sustaining. And self-sustaining businesses are much safer, much more valuable, and much better able to weather economic storms than businesses that depend on external financing. Second, free cash flow is what ultimately determines the value of a business. When professional investors and corporate acquirers calculate what a business is worth, they almost always use some form of discounted cash flow analysis, which projects future free cash flows and discounts them back to the present at an appropriate rate. If you understand free cash flow, you understand the foundation of business valuation. Third, free cash flow reveals things about a business that reported earnings hide. Consider two companies, each reporting $100 million of net income. Company A is generating $120 million of free cash flow. Company B is generating $40 million of free cash flow. On the earnings line, they look identical. But Company A is accumulating real cash far faster than its reported income suggests, because its non-cash expenses, like depreciation, are larger than its actual capital needs, and because its customers pay quickly. Company B, by contrast, is generating far less cash than its reported income suggests, perhaps because it is investing heavily in capital expenditures that the income statement does not fully reflect in the current period. An investor who only looks at earnings would treat these two companies as equivalent. An investor who understands free cash flow sees something fundamentally different. Now, what is a good free cash flow margin? Again, this depends heavily on the type of business. Asset-light businesses, those that can grow without large investments in physical infrastructure, tend to have the highest free cash flow margins. Software companies that deliver products digitally, without factories or physical distribution, can achieve free cash flow margins of 25 to 40%. Companies like this generate significant free cash flow even during periods of heavy growth investment, because their capital expenditure requirements are relatively modest. Asset-heavy businesses, those that require large and constant investments in physical infrastructure to operate, tend to have lower free cash flow margins. Telecommunications companies must invest billions in network infrastructure. Airlines must buy or lease fleets of aircraft. Utilities must maintain vast physical networks. For these businesses, free cash flow margins of 5 to 10% might represent excellent performance because the capital requirements are so large relative to revenue. The key question is always, what is the free cash flow margin relative to peers, and is it improving or declining over time? A company with a declining free cash flow margin, especially in a business that is not capital intensive by nature, deserves careful scrutiny. Something is consuming more cash than it used to. Either the business model is changing in a way that requires more capital, or competition is intensifying and forcing more spending, or customers are becoming slower to pay, or management is making capital allocation decisions that consume cash without proportional returns. Conversely, a company with a rising free cash flow margin is demonstrating that its business is becoming more efficient. It is generating more cash per dollar of revenue, which means the compounding power of the business is increasing. Every dollar reinvested in the business creates more future cash flow than the same dollar would have a few years ago. There is one more important concept to understand when analyzing free cash flow, and it is the distinction between maintenance capital expenditures and growth capital expenditures. Maintenance capital expenditures are the spending required simply to keep the business operating at its current level. Machinery wears out and must be replaced. Technology systems become obsolete and must be upgraded. Physical stores require periodic renovation. This spending produces no new revenue. It simply prevents the business from declining. Growth capital expenditures are investments in new capacity, new locations, new equipment, or new infrastructure that will generate future revenue. A retailer opening new stores is making a growth capital expenditure. A manufacturer building a new factory to serve new customers is making a growth capital expenditure. The reason this distinction matters is that the two types of capital expenditure have very different financial implications. Maintenance capital expenditures are a true cost of the business, as real and inevitable as rent or salaries. Growth capital expenditures are optional investments that should be evaluated on the basis of their expected returns. When Warren Buffett calculates what he calls owner earnings, which we will discuss in depth in Chapter 10, he subtracts only the maintenance capital expenditures from operating cash flow, not the growth capital expenditures. This gives him a more accurate picture of how much cash the business generates just by operating before any growth investments are made. Companies rarely break out their capital expenditures into these two categories in their financial statements. But you can estimate the split by looking at the depreciation expense and comparing it to total capital expenditures. If capital expenditures are close to or below the level of depreciation, the company is probably investing mostly in maintenance. If capital expenditures substantially exceed depreciation, the company is investing in growth, which is worth examining carefully to understand the expected returns. Free cash flow margin is the clearest, most honest measure of how much real wealth a business is creating. Learn to read it, compare it to peers, track it over time, and use it to verify or challenge what the earnings line is telling you. But even strong free cash flow does not tell you everything about how wisely a company is allocating its resources. For that, we need the next number, the one that tells you whether every dollar the business invests is actually creating more value than it consumes. Chapter 5. Return on Invested Capital. The master number. If you could only look at one number to understand the quality of a business, this would be the one. Return on Invested Capital, which is commonly abbreviated as ROIC, is the measure of how efficiently a business converts the capital it has invested into profitable returns. In plain language, for every dollar that has been put into the business, whether by shareholders buying stock or lenders providing loans, how many dollars of profit does the business generate each year? A company that earns 20 cents of after-tax operating profit for every dollar invested in the business has a return on invested capital of 20%. A company that earns 5 cents has a return of 5%. And the difference between these two numbers, compounded over decades, is the difference between extraordinary wealth creation and mediocrity. Here is the intuition behind the number. Every business requires capital to operate. Manufacturers need factories and equipment. Retailers need inventory and store fixtures. Technology companies need servers and software. Service businesses need trained employees and office space. This capital comes from two sources: shareholders who invest in the company by buying equity, and lenders who provide debt financing. The total amount of capital provided by these two sources is called the invested capital, and it sits on the balance sheet in various forms. Return on invested capital asks a simple question about this invested capital. How much operating profit does the business generate from it, after accounting for the taxes owed on that profit? The formula is net operating profit after tax, sometimes abbreviated as NOPAT, divided by invested capital. Invested capital is typically calculated as total equity plus total debt minus cash. The reason cash is subtracted is that cash sitting in a bank account is not doing anything productive for the business. It is simply waiting. The invested capital figure you want captures only the capital that is actively deployed in the operations of the business. Now, why is ROIC the master number? Because it tells you whether the business is genuinely creating value or quietly destroying it. There is a concept in economics called the weighted average cost of capital, often abbreviated as WACC. This is the minimum return that the providers of capital, both shareholders and lenders, require for their investment to be worthwhile. Shareholders require a certain return to compensate them for the risk of investing in a company. Lenders require an interest rate that compensates them for the risk of providing a loan. The weighted average of these two requirements is the hurdle rate that a business must clear just to justify its own existence. If a company earns a return on invested capital that exceeds its cost of capital, it is creating value. Every year of operations makes the business worth more than it was before because the returns generated exceed the price of the capital required to generate them. If a company earns a return on invested capital that is below its cost of capital, it is destroying value. Every year of operations makes the business worth less than it was before because the returns are insufficient to justify the capital invested. This can happen even when the company is reporting positive earnings, because the cost of capital is not an accounting expense. It is an economic reality. This is one of the most important and underappreciated truths in all of financial analysis. A company can report profits every single year while simultaneously destroying the wealth of its shareholders, simply by earning returns below its cost of capital. Most companies have a cost of capital in the range of 7 to 12%, depending on the risk of the business and the current level of interest rates. A company earning a return on invested capital of 8% in a world where its cost of capital is 10% is destroying value, even if it is profitable by accounting standards. A company earning a return on invested capital of 25% is creating value at a remarkable rate, compounding the wealth of its shareholders year after year. The truly great businesses, the ones that generate extraordinary long-term returns for patient investors, tend to share a common characteristic. They earn consistently high returns on invested capital over many years and many business cycles. They are able to do this because they have durable competitive advantages that prevent competitors from eroding their margins. They have pricing power, scale advantages, network effects, switching costs, or proprietary knowledge that creates a protected space within which they can operate profitably without constant competitive pressure. Companies like this exist in every industry and in every country. You can find them in consumer goods, where a powerful brand allows a company to charge premium prices for products whose ingredients cost very little. You can find them in technology, where network effects mean that the dominant platform becomes more valuable with each new user. You can find them in healthcare, where patented drugs have no generic competition for years. You can find them in business-to-business software, where switching costs mean customers rarely leave once they are integrated into a system. The common thread is ROIC. Whatever the source of the competitive advantage, the financial fingerprint is always the same: unusually high, unusually consistent returns on invested capital. Here is something that makes ROIC especially powerful as an analytical tool. Unlike gross margin or operating margin, which measure the profitability of the income statement, ROIC incorporates the balance sheet. It tells you not just how profitable the business is, but how much capital the business requires to generate those profits. Consider two businesses, each earning $10 million of operating profit after tax. Business A has invested capital of $50 million. Business B has invested capital of $200 million. Business A has a return on invested capital of 20%. Business B has a return on invested capital of 5%. Which is the better business? Business A, by a wide margin. It is generating the same earnings with 1/4 of the capital. And because it requires so little capital, it can return most of its earnings to shareholders through dividends or buybacks, or reinvest them in the business at the same high rate of return, compounding shareholders' wealth at a much faster rate. Business B must constantly reinvest large amounts of capital just to maintain its level of earnings. It has little flexibility. And if the returns on that capital ever slip, even slightly, the consequences for shareholder value are severe. This is why capital-light businesses with high ROIC, companies that require relatively little investment to generate significant profits, tend to be among the most valuable in the world. And it is why capital-intensive businesses with low ROIC, even when they are very large and well-known, often disappoint long-term investors. When evaluating ROIC, there are three things to consider. The first is the absolute level. Is the ROIC above the company's cost of capital? For most companies in most industries, you want to see ROIC consistently above 10%, and ideally above 15%. Returns above 25% are exceptional and suggest a very wide competitive moat. Returns below 10% suggest that the business is struggling to earn an adequate return on the capital invested in it. The second is the trend. Is ROIC improving, stable, or declining? Improving ROIC over time is a sign that the competitive advantage is strengthening. Declining ROIC is a warning that something is eroding the business model, whether increasing competition, rising costs, poor capital allocation, or changing customer preferences. The third is the comparison. How does the company's ROIC compare to its competitors? A company that consistently earns a return on invested capital of 15% in an industry where competitors average 8% has a meaningful competitive advantage. The gap is the moat, expressed in numbers. One important note about ROIC calculation. The figure for net operating profit after tax should use a reasonable effective tax rate, and the invested capital figure should be calculated consistently from year to year. Different analysts sometimes make different choices about how to calculate these figures, which can produce different ROIC numbers for the same company. What matters most is consistency. Calculate it the same way every year, and the trend will be meaningful and reliable. ROIC is the master number because it connects the income statement and the balance sheet, reveals whether the business is genuinely creating or destroying value, and exposes the depth of competitive advantages that other numbers may not fully capture. A company with growing revenue, expanding margins, strong free cash flow, and consistently high ROIC is a company that is compounding the wealth of its owners with remarkable power. Every year is better than the last. Every reinvested dollar generates more than the one before. This is the financial engine of genuine wealth creation. But even the strongest engine can be damaged by excessive debt. And understanding how debt relates to cash flow is the next essential step. Chapter 6: Debt to Cash Flow. The danger hiding in the balance sheet. Debt is not inherently bad. This point is worth stating clearly before we discuss how to analyze it. Debt allows businesses to invest more capital than they could raise from shareholders alone, which can accelerate growth. Debt is cheaper than equity for most companies because lenders take less risk than shareholders and therefore accept a lower return. And debt creates tax advantages because interest payments are typically deductible from taxable income. Many of the finest businesses in the world carry significant debt as a deliberate part of their financial strategy. Utilities, real estate investment trusts, and certain manufacturing businesses routinely operate with debt levels that might look alarming without context, and they do so profitably and safely. But debt is a double-edged instrument. When a business is growing and generating strong cash flows, debt amplifies the returns to equity holders. When a business hits a rough patch, when revenue falls, when margins compress, when cash flow weakens, debt becomes a trap. The lenders still need to be paid, regardless of how the business is performing. Interest payments and principal repayments are contractual obligations that do not shrink when revenue does. Too much debt, relative to the cash flow of a business, is one of the most common causes of financial distress and bankruptcy. And learning to identify dangerous debt levels before they become problems is one of the most practically important skills an investor can develop. The ratio to use is debt to free cash flow. This ratio tells you how many years it would take for the company to pay off all of its debt using its current free cash flow. If a company has $2 billion of total debt and generates $500 million of free cash flow per year, the ratio is 4. It would take 4 years of current free cash flow to retire all the debt. The interpretation of this ratio depends on the stability and predictability of the cash flows involved. For a highly stable, predictable business with consistent cash flows, a debt-to-free cash flow ratio of 4 or 5 can be manageable. Utility companies regularly operate at these levels because their revenues are largely regulated and predictable. Their lenders know the cash flows are reliable and are comfortable extending credit even at high debt levels. For a cyclical business, where cash flows can swing dramatically from year to year depending on economic conditions, commodity prices, or demand cycles. A ratio of even 2 or 3 can be dangerous. In the good years, the debt looks comfortable. But when the cycle turns and cash flows fall by 30 or 50%, suddenly the ratio jumps to 5 or 6 or higher, and the company may find itself unable to service its obligations. For growth stage companies, where current free cash flow is low or negative because the business is investing heavily in expansion, this ratio may not be calculable in a traditional sense. For these companies, you need to examine the debt in relation to the expected future cash flows and the runway of cash available to fund operations until profitability is achieved. There are two other debt metrics worth understanding alongside the basic ratio. The first is interest coverage. This is calculated by dividing operating income by interest expense. It tells you how many times over the company could pay its annual interest bill using its current operating income. An interest coverage ratio of 2 means operating income is twice the annual interest expense. A ratio of 3 or higher is generally considered safe for most businesses. A ratio below 2 is a warning sign. A ratio below 1 means the business is not generating enough operating income to pay its interest, which means it is burning through its cash reserves or borrowing more money to pay existing interest, which is a spiral that typically ends badly. The second is the maturity profile of the debt. A company might have manageable total debt levels, but if a large portion of that debt matures, meaning it must be fully repaid or refinanced in the next 2 years, and the credit markets tighten, the company might face serious difficulty. Companies that finance themselves with long-term bonds have much more stability than companies that rely on short-term credit facilities or revolving lines of credit that can be called by lenders. There is an important relationship between business quality and appropriate debt levels. The higher the quality of a business, meaning the more stable, predictable, and large its free cash flow relative to its size, the more debt it can safely carry. A business like Coca-Cola, which generates massive, highly predictable cash flows from a global portfolio of beloved brands, can carry substantial debt because lenders know those cash flows will be there to service the debt in every economic environment. The same debt load would be suicidal for a small airline or a mining company, whose cash flows swing wildly with jet fuel prices and commodity prices. This is why analyzing debt in isolation, without understanding the quality and predictability of the underlying cash flows, is dangerously incomplete. The question is never simply how much debt the company has. The question is how much debt the company has relative to the size and stability of the cash flows that service it. For most investors, analyzing most companies, a debt-to-free cash flow ratio below 3 is generally comfortable. Between 3 and 5 requires deeper investigation and some caution. Above 5 is a red flag that demands a thorough understanding of why the debt is so high, what the plan is to reduce it, and what would happen to the company if its cash flows fell by 30 or 40%. One more practical note. When you calculate debt for this purpose, use net debt, which is total debt minus cash and cash equivalents. The cash a company holds can be used to repay debt, so it offsets the risk of the gross debt level. A company with $2 billion of debt, but $1 billion of cash, has a net debt of $1 billion, which is half the gross debt. The net figure is the more relevant one for analyzing financial risk. Strong revenue growth, excellent margins, robust free cash flow, high return on invested capital, and a manageable debt load, these 5 numbers together paint a picture of a financially sound and compounding business. But there is a hidden danger that all of these numbers can obscure, and it concerns the shares themselves. Chapter 7. Share Dilution. The silent tax on your investment. There is a form of wealth transfer that happens quietly, often without shareholders noticing, and it can significantly reduce the value of their investment over time. It is called share dilution. When you own shares in a company, you own a fraction of the business. If a company has 1 million shares outstanding and you own 1,000 of them, you own 1/10 of 1% of the company. Every dollar of profit the company earns, you are entitled to 1/10 of 1% of it. Every asset on the balance sheet, you own 1/10 of 1%. The value of your stake is directly tied to the total number of shares outstanding and how that number changes over time. Share dilution happens when a company issues new shares, increasing the total number outstanding. If the company issues an additional 1 million shares, bringing the total to 2 million, your 1,000 shares now represent only 1/20th of 1% of the company. Your fraction of ownership has been cut in half, even though the number of shares you hold has not changed. In the corporate world, new shares are most commonly issued in two ways. The first is through equity offerings, where the company sells new shares to investors to raise capital. Sometimes, these offerings are justified and well priced. A young growth company raising capital to fund expansion at a moment when its stock is trading at a high valuation relative to its assets is doing something potentially sensible for existing shareholders. But offerings that are poorly timed, priced too cheaply, or used to fund operations rather than genuine investment opportunities can significantly damage existing shareholders. The second, and by far the most common, source of dilution is stock-based compensation. This is when a company pays its employees, particularly its executives, in the form of restricted stock units or stock options rather than cash. The practice is extremely widespread, especially in the technology sector, where companies compete fiercely for talent and often find it more efficient to pay high earners partly in stock. Stock-based compensation is a real economic cost to shareholders. When an executive receives $1 million of stock as part of a compensation package, the company does not write a check for $1 million. Instead, it issues new shares, which dilutes the existing shareholders' ownership. The cost is invisible in the traditional sense, but the economic effect is identical to paying the executive in cash, taken directly from the shareholders' pockets. Here is how to measure dilution and decide whether it is a problem. Look at the total share count over a period of 5 to 10 years. Is it going up, staying flat, or going down? Calculate the annual rate of change. If the share count is growing at 3% per year due to stock-based compensation, that is a 3% annual headwind on the value of your investment, in addition to any dilution from other sources. Now, 3% might sound modest, but compounded over 10 years, a 3% annual dilution in share count reduces the value of your ownership stake by roughly 26%. You might own shares in a company that grows its earnings at a strong rate, but if that growth is largely offset by constant share issuance, your share of the earnings is growing much more slowly than the company's total earnings would suggest. Compare the share count 5 or 10 years ago to today. If shares outstanding have grown by 15% over 5 years, that is about 3% per year. If they have grown by 40% over 5 years, that is closer to 7% per year, which is a very significant drag. If they have fallen, meaning the company is buying back more shares than it is issuing, that is a sign of shareholder-friendly management. Share buybacks, when done wisely, are the opposite of dilution. When a company repurchases its own shares, it reduces the total number outstanding, which means each remaining share represents a larger fraction of the company. If the company buys back shares at prices below their intrinsic value, the buyback creates genuine wealth for remaining shareholders. If the company buys back shares at inflated prices simply to prop up earnings per share metrics or satisfy short-term executive compensation targets, it can destroy value. This leads to an important nuance. Some dilution is acceptable and even desirable. If a company is growing revenue at 30% per year and share count is growing at 3% per year, the dilution is not a meaningful problem because the per-share earnings and cash flow are still growing at roughly 27% annually, which is exceptional. The key question is always whether the value being created by the business is significantly greater than the value being taken by dilution. But if a company is growing revenue at 10% and diluting shareholders at 5% per year, the real per-share growth that you, as an investor, are capturing is only 5%. And if the company is trading at a high multiple of earnings, meaning you paid a lot for each dollar of earnings, a mere 5% per-share growth may not be sufficient to justify the price. When analyzing dilution, there is one more thing to watch. Some companies are very adept at managing the optics of dilution without addressing the substance. They will report an earnings per share figure that looks acceptable because they are buying back shares to offset the dilution from stock compensation. But if you look at the gross dilution from stock issuance and separately account for the cash spent on buybacks, you may find that the company is spending enormous amounts of cash simply to stand still, returning it to shareholders through buybacks at the same time as it takes it away through compensation. The net effect on share count may look neutral, but the company is consuming cash that could otherwise be compounding. This is sometimes called a treadmill of dilution, and it is more common than most investors realize. Track the share count. Understand the source of any changes. Evaluate the dilution in relation to the business growth. And always ask, is management creating value for shareholders, or are they taking it? The answer to that question becomes clearer still when you look at the quality of the earnings themselves, because not all earnings are what they appear to be. Chapter 8. Earnings Quality. When the profit is not really profit. There is a scene that plays out in financial history with remarkable regularity. A company reports several consecutive quarters of strong earnings growth. Analysts are enthusiastic. Investors bid the stock to high valuations. Management is celebrated. And then, often suddenly, the whole thing collapses. Earnings that looked strong turn out to have been manufactured. The accounting was aggressive, or the revenue was recognized too early, or the expenses were deferred in ways that made current period results look much better than the underlying business actually warranted. This is an earnings quality problem, and it is one of the most treacherous risks in investing because it is invisible to anyone who looks only at the headline earnings number. Earnings quality refers to the degree to which reported earnings accurately reflect the true economic performance of the business. High-quality earnings are those that are reliable, sustainable, and backed by actual cash generation. Low-quality earnings are those that are inflated by accounting choices, one-time items, or estimates that are unlikely to prove accurate. The most reliable way to assess earnings quality is to compare reported net income to operating cash flow and free cash flow. This comparison is sometimes called the accrual ratio, and it measures the extent to which reported profits are supported by actual cash generation. If a company reports $100 million of net income and also generates $100 million of operating cash flow, the earnings are cash-backed. The profit is real. If a company reports $100 million of net income but generates only $50 million of operating cash flow, there is a gap. $50 million of reported earnings are being generated by accounting entries rather than actual cash receipts. This is not necessarily fraudulent, but it deserves scrutiny. The gap between reported earnings and cash flow can arise from legitimate causes. A fast-growing company might have a large accounts receivable balance that is growing rapidly because it is selling more to customers who pay on 60 or 90-day terms. This means revenue and earnings are recognized when goods are sold, but the cash does not arrive until later. The earnings are real. The cash will come. It is just delayed. But the gap can also arise from problematic causes. A company might be recognizing revenue before it is truly earned, booking sales that have not yet been completed, or that customers might still cancel. It might be deferring expenses into future periods, making current earnings look better than they should. It might be using aggressive estimates for warranty reserves, environmental liabilities, or bad debt allowances that make current earnings look higher while building up future charges. Here are the specific warning signs of low earnings quality. The first is a widening gap between reported earnings and operating cash flow. If this gap is growing year over year, earnings quality is likely declining. The earnings are increasingly being generated by accounting rather than operations. The second is rapidly growing accounts receivable relative to revenue. If receivables are growing at twice the rate of revenue, it means the company is not collecting cash as efficiently as before. This might mean customers are taking longer to pay, which can signal financial stress among the customer base. Or it might mean the company is booking revenue too aggressively before cash is actually due. The third is rapidly growing inventory relative to revenue, particularly for manufacturing or retail businesses. If inventory is building up faster than the company is selling it, that inventory may need to be written down in the future, which will reduce earnings. An inventory build that outpaces revenue growth is often a sign that demand is weakening before management is willing to admit it. The fourth is an unusual pattern of meeting earnings estimates by the exact amount Wall Street analysts expected. This sounds strange, but earnings management is real. Companies sometimes use their accounting flexibility to hit consensus estimates precisely quarter after quarter, because missing estimates is punished severely by the market. The very consistency of this perfection can be a sign that management is smoothing earnings by moving revenue and expenses around, rather than reporting results as they truly fall. The fifth is the presence of numerous one-time charges or extraordinary items in the financial statements, especially if they appear repeatedly. Every company has genuine one-time events: a factory fire, a product recall, a regulatory settlement. But a company that takes a restructuring charge every year and calls it one time is using accounting games to exclude real costs from headline earnings. These costs are real, they are not exceptional, and an investor who ignores them because management calls them non-recurring is underestimating the true cost of operating the business. The sixth is a consistently growing divergence between adjusted earnings, the non-GAAP figure that management emphasizes, and GAAP earnings, the one calculated according to standard accounting rules. Companies legitimately use non-GAAP measures to exclude non-cash items and acquisition-related costs that can obscure underlying business performance. But when the adjustments are large, growing, and consistently favorable to management, it is worth asking who is benefiting from these redefinitions. Beyond these warning signs, there is a broader principle about earnings quality worth internalizing. The most trustworthy earnings are those generated by a simple, consistent, and understandable business model that has not changed significantly over time. A company that sells the same products through the same channels with the same cost structure year after year is much easier to analyze than a company that is constantly changing its business model, acquiring new companies, entering new markets, and restructuring its operations. The more complexity there is, the more places there are for accounting choices to be made, and the harder it is to see what the underlying economic reality is. Simple businesses with consistent earnings, strong cash flow conversion, and clean accounting statements are among the safest investments. Their earnings quality is high because the underlying economics are transparent and easy to verify. Evaluating earnings quality requires some detective work, but the returns on that detective work are significant. Catching a company with low or deteriorating earnings quality before the market does can help you avoid devastating losses. And identifying a company with consistently high earnings quality in a market that is rewarding its competitors can help you identify overlooked opportunities. With 8 of our 10 numbers examined, we have covered the operational and financial health of the business. Now, it is time to ask the question that ties it all together. Given everything we know about this company, what should we pay for it? Chapter 9. Valuation Multiples. What are you actually paying? Understanding that a business is excellent is only half of the investment equation. The second half is understanding what you are paying for that excellence. And this is where many investors, even experienced ones, make their most consequential mistakes. An excellent business, bought at an excessively high price, can be a poor investment. A mediocre business, bought at an extremely low price, can be a spectacular one. The relationship between the quality of the business and the price you pay for it determines almost everything about the long-term returns you will receive. Valuation multiples are the tools we use to express the relationship between a company's price and its financial performance. They tell you, in simple ratio form, how much the market is asking you to pay for each unit of the company's earnings, cash flow, revenue, or book value. The most commonly cited valuation multiple is the price-to-earnings ratio, which is usually abbreviated as the P/E ratio. It is calculated by dividing the market price of a single share by the earnings per share. If a stock is trading at $50 and the company earned $2 per share over the past 12 months, the P/E ratio is 25. This means investors are willing to pay $25 for every $1 of annual earnings. The P/E ratio is useful but has significant limitations. Because it is based on reported earnings, it inherits all the problems of earnings quality we discussed in the previous chapter. A company with low-quality earnings has a P/E ratio that overstates how cheap or expensive it truly is. Additionally, the P/E ratio is affected by accounting choices that distort reported earnings, including depreciation schedules, tax treatments, and various accruals. A more reliable valuation, multiple for many purposes, is the enterprise value to free cash flow multiple. Enterprise value is the total value of the company to all capital providers, both debt and equity holders. It is calculated by taking the market capitalization of the company, which is the share price, times the total number of shares outstanding, adding the net debt, and subtracting any cash holdings above what the company needs to operate. When you divide enterprise value by free cash flow, you get a multiple that tells you how many years of current free cash flow you are paying for the entire business. If a company has an enterprise value of $5 billion and generates $250 million of free cash flow, the multiple is 20. You are paying 20 times the current annual free cash flow. Is 20 times free cash flow expensive or cheap? It depends entirely on the growth rate of that free cash flow and the quality of the business. Think about it this way. If a business generates $250 million of free cash flow today, and that figure is growing at 20% per year, within 5 years, the business will be generating over $600 million of free cash flow annually. The investor who paid 20 times current free cash flow today would, in 5 years, be paying less than 9 times the then current free cash flow on the basis of what they originally paid. If the business continues to grow, the effective multiple they are paying continues to fall. This is called multiple compression from the buyer's side, and it is a very powerful force. Conversely, a business generating $250 million of free cash flow that is growing at only 3% per year and trading at 20 times free cash flow is quite different. In 5 years, it will be generating roughly $290 million of free cash flow. The investor is essentially paying an amount today that they will recoup from free cash flow over 20 years, with almost no growth to accelerate the timeline. In that context, 20 times may be quite expensive. Growth rate is the key variable that makes the same valuation multiple reasonable in one situation and absurd in another. The mathematical relationship between growth and valuation is sometimes expressed through a rule called the PEG ratio, which stands for price-to-earnings growth. It is the P/E ratio divided by the expected earnings growth rate. A company with a P/E ratio of 25 and expected earnings growth of 25% has a P/E-G ratio of 1. A company with a P/E ratio of 25 and expected earnings growth of 10% has a P/G ratio of 2.5. The lower the PG ratio, the more growth you are getting for each unit of valuation. Peter Lynch popularized the PG ratio as a simple tool for identifying stocks that are cheap relative to their growth. He considered a PG ratio below 1 to represent a potentially attractive opportunity. But like all rules of thumb, it should be used as a starting point for analysis rather than a final answer. Beyond the PE and free cash flow multiples, there are two other valuation tools worth understanding. The enterprise value to EBITDA multiple is widely used, particularly by investment bankers and private equity investors. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. The multiple captures the valuation before the effects of capital structure, taxes, and accounting-based depreciation. It is useful for comparing companies with different debt levels and tax situations, and it provides a rough approximation of the cash generation potential of the business. However, it is not as clean as a free cash flow multiple because it does not account for the actual capital expenditure requirements of the business. The price-to-sales multiple is most useful for companies that are not yet profitable, particularly young growth companies investing heavily in expansion. If a company has no earnings and no free cash flow, you cannot calculate a PE or free cash flow multiple. But you can observe that the market is willing to pay, say, 15 times annual revenue for the business. By comparing that to the revenue multiples of comparable companies and understanding the potential margins of the business at maturity, you can form a view on whether the valuation is reasonable. Price-to-sales multiples vary enormously by industry and growth rate. A software company at 15 times revenue might be reasonably valued if it is growing at 40% annually and has a clear path to high operating margins. A food manufacturer at 15 times revenue would be grotesquely overvalued because the margins and growth rates of that industry simply cannot generate enough cash flow to justify the price. Now, there is something important about valuation multiples that goes beyond the mathematics. Valuation multiples reflect market sentiment and investor expectations as much as they reflect underlying business economics. During periods of exuberance, when investors are enthusiastic and money is cheap, multiples expand. Companies trade at 20, 30, 40, 50 times earnings or free cash flow. During periods of fear or rising interest rates, multiples contract. The same company might trade at 12 times earnings because the mood of the market has shifted. This means that understanding valuation multiples is not just about finding cheap stocks. It is also about understanding the emotional state of the market and recognizing when that emotional state has made sensible companies unreasonably cheap, or when it has made speculative companies irrationally expensive. The patient investor who can identify a genuinely excellent business with strong fundamentals across all the metrics we have discussed, trading at a reasonable or even modest valuation multiple, has found something rare and valuable. The combination of quality and price is the foundation of every great long-term investment. We have now examined 9 of our 10 numbers, and all 9 have been building toward this final one, the number that Warren Buffett considers the most important concept in investing. Chapter 10: Owner Earnings. What the business is really worth to you. In 1986, Warren Buffett included a passage in his annual letter to shareholders of Berkshire Hathaway that quietly revolutionized the way sophisticated investors think about business valuation. In that letter, Buffett defined a concept he called owner earnings, and he said, with characteristic directness, that this was the measure that really mattered for determining the intrinsic value of a business. Owner earnings, in Buffett's formulation, are calculated as follows. Start with reported net income. Add back depreciation and amortization, because these are non-cash expenses that reduce reported income without reducing cash. Subtract the capital expenditures required to maintain the current competitive position of the business, the maintenance capital expenditures we discussed in Chapter 4, and subtract any additional working capital required to support the business as it grows. What remains is the owner's share of the economics. It is the cash that the business generates that genuinely belongs to its owners, free to be distributed as dividends, used for buybacks, or reinvested in growth opportunities at the owner's discretion. The concept is powerful because it cuts through accounting complexity and gets to the fundamental question that every investor should be asking. If I own this business completely, how much real money does it put in my pocket each year? Notice what owner earnings exclude. They exclude growth capital expenditures because those are investments chosen by management, not costs required to maintain the current business. If management chooses to invest $100 million in new factory capacity, that is an investment decision, not a cost of the existing business. Owner earnings also exclude the non-cash accounting charges that obscure the true cash economics of the business. Owner earnings is particularly useful for businesses that have very different accounting profiles from their cash reality. Consider a company that owns a large number of depreciating assets, like a cable network or a pipeline. The depreciation on those assets reduces reported net income significantly. But the actual cash maintenance costs may be much lower than the accounting depreciation suggests, because the assets are durable and do not need to be replaced as quickly as the accounting rules assume. In these cases, owner earnings substantially exceeds reported net income, and the business is more valuable than the income statement suggests. The reverse is also true. A company that has low depreciation charges but must constantly invest in new equipment or technology to remain competitive has owner earnings that are substantially lower than reported net income, because the true cost of maintaining the business is higher than the accounting reflects. To calculate the yield that owner earnings represents, divide the annual owner earnings by the current enterprise value of the business. If owner earnings are $200 million and the enterprise value is $4 billion, the owner earnings yield is 5%. This is the annual return you would earn from the business simply from its current earnings before any growth. If the business is also growing owner earnings at 15% per year, your total expected return as an owner of the entire business is in the vicinity of 20%. This is a deeply intuitive way to think about investment returns. It is exactly how a private business owner thinks. They want to know how much cash the business generates that belongs to them, how much that cash flow is likely to grow, and what they are being asked to pay for all of it. Owner earnings connects the analytical work of all 9 previous chapters into a single, comprehensive measure of what the business is worth to the person who owns it. High revenue growth means owner earnings will be larger in the future. High gross and operating margins mean a large fraction of revenue flows through to owner earnings. Strong free cash flow conversion means owner earnings and accounting earnings are closely aligned, signaling quality. High return on invested capital means reinvested owner earnings generate significant additional owner earnings in the future. Manageable debt means the cash flows of the business are not encumbered by excessive interest obligations. Low dilution means owner earnings per share are growing nearly as fast as total owner earnings. High earnings quality means the owner earnings figure can be trusted. All 9 numbers come together in owner earnings. And owner earnings is what you use to assess whether the valuation multiple is justified. An excellent business with growing, high-quality owner earnings, trading at a valuation where the owner earnings yield plus the expected growth rate produces an attractive total return, is the target. Finding that combination is the purpose of everything we have discussed. Chapter 11. Turning 10 numbers into one decision. You have traveled through 10 chapters, 10 numbers, 10 lenses for understanding a business. Now comes the work of bringing them together. Here is the framework. When you analyze any publicly traded company, you are asking a series of questions, and each of the 10 numbers answers one of them. Revenue growth answers: Is the business expanding? Gross margin answers. Does the business have pricing power? Operating margin answers. Is the business run efficiently? Free cash flow margin answers. Are the earnings real? Return on invested capital answers. Is the business genuinely creating wealth? Debt to cash flow answers. Is there danger in the balance sheet? Share dilution answers. Is management treating shareholders fairly? Earnings quality answers. Can the financial statements be trusted? Valuation multiples answer. What is the market asking me to pay? Owner earnings answers. What is the business truly worth? When you go through this process methodically, something interesting happens. The numbers start to tell you a story, and that story is usually quite clear. Sometimes, the story is simple and excellent. Revenue is growing at 20%, gross margin is 70% and expanding. Operating margin is 20% and improving. Free cash flow conversion is strong. Return on invested capital is 25%. Net debt is minimal. Share count is flat or declining. Earnings quality is high, and the valuation is not excessive. Every number is pointing in the same direction. The business is exceptional, the management is trustworthy, and the price is reasonable. This is the easiest decision you will ever make as an investor. You buy and you hold for a very long time. Sometimes, the story is simple and poor. Revenue is growing modestly. Gross margin is thin and contracting. Operating margins are negative. Free cash flow is deeply negative. Return on invested capital is below the cost of capital. Debt is excessive. Shares are being diluted rapidly, and earnings quality is questionable. The valuation may look cheap on a surface metric, but the underlying business is consuming capital and producing little. This is the stock you avoid, regardless of how compelling the narrative sounds. The more common and more interesting scenario is when the story is mixed. Some numbers are encouraging. Others raise concerns. This is where judgment becomes essential. Here is a framework for handling mixed signals. First, identify the most important numbers for the particular type of business you are analyzing. For a young software company, revenue growth and gross margin are paramount because these define the eventual earnings potential of a business that is currently investing for scale. Operating margin and free cash flow may be temporarily weak by design, and that is acceptable if the strategic rationale is clear. For a mature consumer goods company, gross margin trend, operating margin, and return on invested capital matter most because the growth phase is over, and what remains is the question of capital efficiency and sustainability. Different industries, different stages of development, and different competitive situations make different numbers most relevant. The framework is universal. The weighting is situational. Second, distinguish between temporary problems and structural ones. A company experiencing a one-year decline in free cash flow margin because it is building a new distribution center is a very different situation from a company experiencing a multi-year decline because its core market is commoditizing. Temporary problems that are well understood and have a clear resolution timeline may actually represent buying opportunities. Structural problems that are inherent to the business model are unlikely to resolve themselves. Third, apply a margin of safety. No financial analysis is perfect. The numbers you are working with are historical. The future is uncertain. Management teams change. Competitive environments shift. Technologies disrupt. Given this uncertainty, the price you pay for a business should be conservative enough that even if your assessment is partially wrong, your investment is not catastrophic. The margin of safety is the gap between what you estimate the business is worth and what you pay. Fourth, think about the trajectory, not just the snapshot. A business whose numbers are modestly attractive today, but are all trending in the right direction, revenue growth accelerating, margins expanding, return on invested capital improving, share dilution declining, may be a far better investment than a business whose numbers look great today, but are all trending in the wrong direction. The direction matters as much as the current position. Fifth, do not over-diversify to the point where you cannot think carefully about each position. There is a temptation, born of reasonable caution, to spread investments across dozens of companies. But when you own 50 stocks, you cannot possibly know each one well enough to have confident views on its trajectory. The greatest investors tend to concentrate in their highest conviction ideas while maintaining enough diversification to survive being wrong. 10 to 20 well-understood positions is a reasonable range for a disciplined individual investor. Sixth, let compounding do its work. Once you have identified a business that scores well across all 10 numbers and you have bought it at a reasonable price, give it time. The power of compounding is not theoretical. It is the most powerful force in wealth creation. A business that grows its owner earnings at 15% per year will approximately double its earnings in 5 years and quadruple them in 10. An investor who buys such a business at a fair price and holds for 10 years will capture most of that quadrupling in the form of investment returns. But they must actually hold. Every unnecessary sale, every tax-triggering exit, every switch from a great business to one that looks slightly more interesting this quarter is friction that reduces the compounding return. The 10-number framework is designed to help you identify businesses worth holding for a long time. Not businesses to trade in and out of. Not businesses to sell whenever the market gets nervous or a competitor announces a new product. Businesses that are genuinely exceptional, financially sound, fairly priced, and worthy of your long-term confidence. The framework will not tell you exactly when to buy or sell. No framework can do that honestly. What it will tell you is whether a business is genuinely high quality, whether the price you are being asked to pay is reasonable for that quality, and whether the overall financial trajectory is one that justifies long-term confidence. That combination, quality, price, and trajectory, is the foundation of every great long-term investment decision. And it is accessible to anyone willing to look at 10 numbers. A final word. The investors who consistently build wealth over long periods of time are not the ones who are smarter than everyone else. They are not the ones with access to special information or sophisticated mathematical models. They are not the ones who trade most frequently or react most quickly to news. They are the ones who understand what they own. They are the ones who can look at a financial statement and tell you whether the business behind it is excellent or mediocre, growing or stagnating, financially strong or dangerously leveraged. They are the ones who know, with genuine conviction, why they own each investment and who do not need the daily affirmation of a rising stock price to feel confident. The 10 numbers in this book are the foundation of that kind of understanding. Revenue growth, gross margin, operating margin, free cash flow margin, return on invested capital, debt to cash flow, share dilution, earnings quality, valuation multiples, owner earnings. Memorize them. Apply them consistently. Follow them honestly, even when the results are uncomfortable. Let them guide you toward businesses that are genuinely excellent and away from businesses that only appear to be. The day you look at a brokerage statement and understand, truly and deeply, why every number on it is what it is the day that investing stops being something that happens to you and starts being something you do with clarity, confidence, and purpose. That day can begin right now.